Are Australian mortgages about to skyrocket? Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's have a look at this article written by Tarek Brooker discussing the risk of Australian mortgages potentially, payments increasing up to 56% if a particular US inflation scenario plays out. So we'll have to look at that. Now, before we jump through that article, I put a poll to my viewers. I put a poll and I asked the viewers, how much would your mortgage payment have to increase for you to be stressed? We see all of the reporting, and Martin North does his surveys about mortgage stress, but really, how much would it have to increase in order for you to be stressed? We have a look here. This is the up to the date, and I'll just refresh this right here. Up to the date survey results, 766 votes. Now, 31% said their mortgage repayments would have to increase by 50% to get stressed about it. 9% said 100%, 3% said 200%, and 9% also said over 200%, with 47% answering they do not have a mortgage. So just think about that. If you're paying, how much? $1,500 a month? A couple of grand a month? $4,000 a month? If that doubled, if that tripled, would you be able to handle it? How much wiggle room do you have with your cash flow and your sources of income? Because, well, it might happen. You never know. But I'd say a lot of people are just worrying about being able to service it now forever based on the current rate. So let's have a look to see what he's written here in this article. So, Aussie mortgages could see 56% increase if a US inflation scenario plays out. And remember that we've got Biden running the US for us, so in the children's fairy tale, Goldilocks and the Three Bears, Goldilocks encounters three bowls of porridge. One that is too hot, one that's too cold, one that is too hot, until, of course, she settles on one that's just right. Shouldn't she mix the too hot and the too cold ones? Maybe I've been watching too much Family Guy. As the world continues its long and challenging recovery from the coronavirus pandemic, the global economy and Goldilocks, ironically, have a great deal in common. Economies around the world must not be too cold, recessionary and deflationary, or too hot, inflationary, lest major issues begin to swiftly arise. Going forward, the global economy faces the contradictory forces of struggling economies around the world, relatively anemic recoveries outside of nations that have engaged in enormous levels of stimulus, and declining demographics in most of the world's largest economies. At the same time, the ghost of inflation that scarred households in the 70s and 80s may have returned to haunt us once more. But how does this impact Aussie house prices? Let me explain. Demand outweighs supply. As Western nations, most notably the United States, continue to pump trillions of dollars into their economy, there is simply too much demand for goods and not enough supply. Spending that normally goes towards things like travel, entertainment, and dining out is being redirected towards retail and other goods. Due to this unprecedented increase in demand, wait times for finished goods and raw materials have blown out to all-time highs according to some indexes. And here's the K-shaped consumer spending recovery, retail spending on services and on goods. Well, see, that's the thing. You can't magically money print goods, can you? At the same time, supply chain disruptions and increased consumer demand has resulted in the prices paid by manufacturers in the US rising at the fastest rate in over 40 years. As a result of these higher costs and supply chain issues, some large multinationals have already announced that they will soon raise their prices. Most notably Coca-Cola, Procter & Gamble, the conglomerate that owns many household brands including Oral-B, Vicks, and Pantene, have both committed to raising prices. And we've seen this and spoken about it on my HeiseSaysUS channel. Everyone in the supply chain, like the cost of oil is going up. It's flowing through with a lot of these manufacturers. So much food is packaged in plastic too. According to the latest US inflation figures, these forces may be starting to significantly impact the price paid by American consumers. A rise in inflation. In April, US consumer price inflation rose by a whopping 0.8% for the month, making the largest single-month rise in US inflation since '81. We can see it here. Wall Street was extremely shocked by the magnitude of the inflationary impulse for April, with the consensus estimates for analysts sitting around 0.2%. Even before the recent inflation figures rattled global markets, pressure was already building on the US Fed to consider raising interest rates if inflation becomes a significant issue. Earlier this month, the former US Federal Reserve Chairwoman and current Treasury Secretary, Janet Yellen, stated in an interview that the Federal Reserve may need to raise interest rates to counter rising levels of inflation. In a recent op-ed for Bloomberg, former New York Federal Reserve President William Dudley estimated that the federal funds rate, the US equivalent of our RBA cash rate, could raise as high as 4.5% as the Fed attempts to cope with a more inflationary future. Between the growing likelihood that the global economy may be scarred in the long term by the pandemic and rising concerns about inflation, the just right zone for the world economy is arguably narrowing. And how would these scenarios impact Australia? So high inflation. If Dudley's worst case high inflation scenario was to be realised, a 4.5% increase in the cash rate, Aussie mortgage holders would face a significant increase in their repayments. Based on the new mortgage size for an owner-occupier of 478,000 and the RBA average rate payable on new loans, mortgage repayments would rise from $2,217 a month to $3,471 per month. This would amount to an increase in monthly repayments of over 56%. And would almost certainly result in a large number of households falling into mortgage stress. Mortgage stress is generally defined as households spending more than 30% of their pre-tax income on paying their mortgage. So deflation. In a deflationary scenario, where trillions in stimulus fails to adequately underpin the global economic recovery, the Aussie economy would likely head back into recession. Unemployment would also rapidly begin to rise, without yet another round of large-scale interventions by the federal government. However, this scenario holds a number of uncertainties. Unlike a high inflation future, which is much harder for central banks and political leaders to address, it's entirely possible, even likely, that the government could simply throw another couple $100 billion at the economy. Well, yeah, that's what they'd do. I'd bet a carton that that's what the government would do here in Australia. The precedent's been set. It doesn't matter who you vote in. So into an uncertain future. As economists and commentators have shown in recent months, predicting where the global and Australian economies may head from here is more challenging than ever. Around the world, even some of the world's most prominent investors and former senior central bankers are raising alarms about the possibility of runaway inflation. In a world where interest rate hikes to counter these forces could be devastating to asset prices. Meanwhile, multiple data releases in the United States and elsewhere have pointed to the downside in a big way, raising concerns that the stimulus-driven recovery may already be showing signs of slowing. It's entirely possible that the world may once again muddle through the coming years as it has before. But as the distortionary effects of over $24 trillion in global stimulus feed into the world economy and ultimately fade away in time, risks continue to build that the Goldilocks global economy may find that things end up being too hot or too cold. So what is the takeaway or the lessons from this, or how really should we prepare? I mean, the question is, if we're going to see the potential, if you've got a mortgage and potentially a 50% increase or 100% increase in your payments, what are you able to handle it? Are you able to handle it? Looking just at the results from this survey, a lot of people who've answered would be stressed out with a 50% increase. And I didn't say, would you be in mortgage stress? I asked if you'd be stressed out. It's a little different. I think that a lot of people that would be suffering mortgage stress and just paying 30% of their pre-tax income, and they go, we're used to it. We don't know any difference. But, if you're cutting it really thin, really tight, I think the maybe the definition for mortgage stress or being stressed with servicing your mortgage, maybe that needs to change. Maybe that 30% is a bit out of date. Maybe if you go your whole younger years saving every single penny you can just to get a deposit, paying 30% may be a saving. But, I mean, if you haven't, everyone should have a budget. And I'm sure most of the viewers of this channel already would or understand where their money's going. Some people may not. They may just stumble upon this video. You know, you want to develop a diverse sense of income sources. Guys, you want to have money coming from a variety of locations just in case you lose your job or something falters. Or you can, build something up to bring additional income in to help offset that mortgage increase. What advice would you give someone? Anyway, guys, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and enjoy the content I create here, there are a few ways you can support us. You can join us on YouTube or Patreon. You can sign up for SelfWealth or Stake, use our affiliate links at Amazon, eBay, Independent Reserve, or HeiseBroadband, buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care. I'll see you next time. Bye for now.